Good morning, everyone. Thank you for joining us today. My name is Nermina Isom, and I'll be your host for this webinar on post-corporate tax season. Before we dive into the session, let me provide a brief introduction to our company. So, ACME Group has established itself as a trusted tax financial solutions provider across the GCC region and Egypt. We're committed to delivering a high quality solutions tailored to the needs of various businesses across different industries. Our focus on quality and expertise has allowed us to build a long-term relationships with our clients. Our exceptional team consistently delivers value efficiently, making us the preferred service provider in the region. Now let me introduce our esteemed speaker for today's webinar, Ms. Aditi Bosch. Ms. Aditi is a is Associate Tax Director, ACCA professional with over 3 years of experience. She's a proficient in tax documentation, return preparation, and our client advisory on compliance. She excels in managing tax registrations, penalty waivers, tax refunds, reconciliation requests, and providing strategic advice to business operating within the UAE. Her expertise includes overseeing excise tax and federal customs regulations, tax litigations, and preparing expert reports for audits and fraud investigation in the UAE. So before we dive into the session, I encourage everyone in the audience to share your questions in the Q&A section. This will help create an interactive session and ensure that you gain the maximum value from today's webinar. Your participation is essential to the success of this event. I would now like to hand over the stage to Ms. Aditi to begin the webinar.
Hi, Nirmeen. Thank you so much for the wonderful introduction. And hello, everybody. Good morning. Welcome to today's session. So, now let's move to the next slide and we'll talk about what we'll cover in today's webinar. Next slide, please. All right, perfect. So, my friends, today we'll be talking about what happens next. As all of us know that the compliance season is over, as all of us know that most of us have already filed our corporate tax returns on the 30th of September 2025. So, what is next? So, my friends, what is next is FTA audits. Yes. Now it is expected that the FTA shall start sending show cause notices. They shall ask for additional information. They shall have to understand that how you've categorized some of your transactions, how you've categorized your expenses, what expenses you've considered as allowed, what expenses you've considered as disallowed. Secondly, from the transfer pricing perspective, they'll focus on the fact that which entities have you categorized as your related party transactions, who are the individuals whom you've categorized as your connected persons, what are the remunerations which you've paid to them, and how have you determined all of that to be at market value, which means how have you determined all of that to be at arm's length price. So, my friends, let's go through the table of contents which we'll talk about today. Today, we'll talk about the fact that what are the areas on which the FTA shall focus from the corporate tax point of view, what are the areas on which the FTA shall focus from the transfer pricing point of view, and what is the way forward for FY ending 2025. We shall discuss about all these topics today, my friends. So, let's move to the next slide. Next slide, please. Next slide. All right, now to begin the session. Now, what happens next? As we know that the compliance season is over. Now, for who was the compliance mandatory to be done on 30th of September 2025? So, my friends, I'm sure many of you in the audience out there who are the taxpayers, right? Your financial year or your tax period would have started from Jan to December 2024. So, for whosoever the tax period was from Jan to December 2024, for all of you, the date for return filing or the deadline for meeting the corporate tax compliance was 30th September 2025, which was 9 months from the end of the relevant tax period. Now, what was mandatory to be done by 30th September 2025? So, my friends, let me take a step back and let me tell you the preface of corporate tax compliance. Now, as all of you are aware, there was a threshold of the financial statements to be audited. So, in case you are a mainland company, and in case for a mainland company, your turnover was exceeding 50 million dirham for FY ending 2024, which means during the period from Jan to December 2024, then it was mandatory for you as a mainland company to get your books of accounts audited? Number one. Now, point number two, let's say you're a free zone company. Now, for a free zone company, irrespective of your revenue, yes, my friends, irrespective of your revenue, for a free zone company, if you want to claim the qualifying free zone person benefit, in that case, again, I reiterate, irrespective of your revenue threshold, you have to get your books audited. All right. So for a free zone company to be eligible to becoming a qualifying free zone person, to be eligible to get the zero rated benefit, you had to get your books audited. Now, last but not the least, irrespective of your turnover, I again mention, let's say it is a requirement of your licensing authority. Because we've seen many cases wherein whenever you approach the licensing authority to, let's say, renew your trade license, let's say your trade license has expired, you need to renew a trade license, or let's say you need to add another business activity to your trade license. In those situations, also the licensing authorities were also requesting for furnishing the audited financial statements. So whether you fall under any of these categories, you have to see whether you have to get your books audited or not, number one. Number two, my friends, even out of abundant caution, it is advised that to present a true and fair view of your financials in your corporate tax return during the corporate tax compliance season, it is advised that you get your books audited from an independent statutory auditor. That is the first thing. Now, what happens for 2025? Now, as we know, we are in the 10th month of 2025, and for all the taxpayers whose tax period is Jan 2025 to December 2025, for all of you, the deadline to file the corporate tax return shall be 30th September 2026. Yes, my friends, so please be very careful. Have a look at your corporate tax registration certificates and see that what is the tax period which your company is following. Depending on that, you would have to meet the corporate tax compliance deadlines. And let's say you've made some errors, some negligence, some mistakes during 2024. Please be careful and ensure that all those errors or mistakes are not repeated during 2025. So we have to be very careful that we have a look at our books of accounts. We have to be very careful that we see that how have we classified our expenses as per Article 28 or as per Article 32 for entertainment, as per Article 33 for disallowed expenses, right? We have to see how we are categorizing them, how we are taking deductions of the allowed expenses, whether we are taking care of the thresholds which are there, let's say for interest expense, let's say for entertainment expense. And we also have to be very, very careful for the fact that wherever we have incurred any personal nature expenses, number one, or any expenses which are of a mixed use case, which means partially personal and partially official in nature, let's say your travel expenses, let's say your transport expenses, all those expenses shall be disallowed in the corporate tax return. So please be very careful that you have a closer and a clearer look at your trial balances, at your profit and loss account for the year 2025 so that you're able to meet the deadline for 30th September 2026, not just timely but also accurately with all the seamless and correct facts. We can move to the next slide, please. All right, that brings us to the first poll question of the day, my friends. And the question is, do all juridical persons need to file the corporate tax return? You have 30 seconds to answer. Your time starts now. All right. Thank you so much, everybody, for answering that question correctly. And almost 90% of the people have answered the question correctly, saying that yes, juridical persons need to file the corporate tax return. We will discuss about this in greater detail as we move to the next slide, please. All right, perfect. Now, my friends, let's talk about what happens during the compliance. What are the details or what are the things on which each taxable person should focus now during 2025 so that you're able to meet the compliance deadline, as I said, not just timely but also accurately. So, my friends, since you are a taxable person, since you are a taxpayer, right? What are the things on which you should lay emphasis and what are the things on which you should be careful about to see before you go for ultimately filing your corporate tax return on 30th September 2026? Now, my friends, number one, it is always advised that you have a look at your trade license. You see that under what category is your entity established. Are you an establishment? Are you a sole establishment? Are you a sole proprietorship? Are you an unincorporated partnership? Or are you an LLC or a free zone company or a free zone entity? Now, depending on what entity type your company falls into, depending on what entity type the entity falls into, right? The legal entity which you have. Depending on that, you have to see that what are the conditions which you have to meet. I will give you an example there. Let's say, as per your trade license, you are a sole establishment, or let's say, as per your trade license, you are an establishment or an unincorporated partnership. In all those situations, my friend, you shall be considered as a natural person in the eyes of the corporate tax law. Yes, my friends, sole establishments are considered as natural persons in the eyes of the FTA. And if you are a natural person, you have to see that whether during the current tax period, now I'll talk about 2025, whether during the current tax period of Jan to December 2025, is your turnover crossing 1 million dirhams, right? If your turnover crosses 1 million dirhams, only then you have to register this trade license, only then you have to register your entity for corporate tax. Number one. Number two, if you register yourself for corporate tax, then yes, the follow on compliance gets applicable on you, which means what? Which means that you have to file your corporate tax return by 30th September 2026. That is for natural persons. Now, number two, when we talk about legal entities incorporated, and by legal entities incorporated, I mean whether we are an LLC or whether we are a free zone company or whether we are a free zone entity, right? Irrespective of which legal form we fall into, irrespective of the revenue turnover we have to register ourselves for corporate tax. Yes, my friends, if you're getting any new licenses issued during this year 2025, please be careful if you're a legal entity incorporated. Again, I reiterate, irrespective of your revenue threshold, you have to get the entity incorporated, or you have to get the entity registered, number one. Number two, you have to file the corporate tax return. So please be very careful with respect to your correct entity identification. Point number one. Point number two, when we talk about what is the jurisdiction where we are located, right? Are we a mainland company? Are we a free zone company? As all of us know that if we are a mainland entity, then we can go for tax optimization, wherein we can get the benefit of the first 375,000 from our accounting income, which is a net profit, and the balance accounting income, which is the balance net profit, shall be taxable at 9%. And how can we reduce this incidence is by seeing that what are the expenses under the ambit of corporate tax law under Article 28, which can be claimed as deductions. So that is the best optimization which is available for mainland companies. Similarly, for free zone companies, my friends, we have to see which free zone are we situated into. Now, going back to our previous webinars and all the previous discussions which we had during 2024, as all of us know, all designated zones are free zones. Yes, all designated zones are free zones, but not all free zones are designated zones. Yes, my friends, we've discussed about this concept multiple times in our previous discussions as well. That we have to see that if we are a free zone company, then in which free zone are we located, right? Now, we have to see if you're in designated zone, what are the kind of activities which we are undertaking, and for which entities is designated zone very, very important and supremely important. It is for distributors, retailers, resellers, traders. Yes, my friends, we know that if we are into distribution activity, if we are situated in designated zone, then as per the new ministerial decision also 229 read with 230, it categorically says that for whatever goods or services are moving from the designated zone in or out from the designated zone outside in UAE or even for local sales, right? All those revenue for this entity in designated zones shall be subject to 0%. Yes, my friend. So you have to be careful what is the activity which you're undertaking. If you're in designated zone, if you're doing distribution, then yes, there are several benefits which are available to you. Moreover, if we talk about the other free zones, then we have to see that whatever transactions you're having between free zone to free zone, those shall be subject to 0% if they fall within the qualifying activity list. So, my friends, if you're a free zone company, please be very careful. Have a closer look at the ministerial decision number 229, read with ministerial decision number 230, right, to see that what are the activities which we are undertaking, which free zone are we located in, and how can we get the qualifying free zone person benefit. And again, I reiterate one more important point is that let's say we get the qualifying free zone benefit for this year, which is 2025. So as an entity, we are eligible for this benefit, not just for 2025, but for the coming forward subsequent 4 years as well. Yes, my friends, for free zone, please be careful and mindful. If you get the benefit this year, you shall get it for the coming 4 years. But on the flip side, if you lose the benefit this year, you shall lose it for the subsequent 4 years as well. All right. And to ensure that you're getting the benefit or not, there are six conditions as per Article 18. Yes, my friends, there are six conditions which your entity has to meet to ensure that you get the 0% benefit. Now, what are these six conditions? These six conditions comprise of adequacy, de minimis qualifying activities, having your books of accounts audited, like I said, having your transfer pricing documents in place, which means whatever related party transactions you're having or whatever payments you're making to your connected persons, you have to justify those kind of transactions and those kind of payments to be at fair market value, which means to be at arm's length price to the FTA. So, my friends, please be very, very careful of all these aspects. And last but not the least, to become a free zone person, in your corporate tax return, you do not have to select that you want to be subject to corporate tax. Yes, my friends, as many of you would have filed your corporate tax return by now, you would have seen that in the return there is a particular dialog box or a checkbox wherein the FTA requests on the MRO tax portal and they ask the taxpayer, do you want to subject to be elect for corporate tax? You have to select no in that. Why? Because if you elect to be subject to corporate tax, then you are electing to be subject to 9% corporate tax. So if you want to claim the free zone benefit, then you have to select no in that dialog box. Let's move to the next slides, please. All right, my friends. Now, in the compliance, there is another aspect which all of us should focus on and which all of us should be careful about, which is the elections. Yes. Now, I'm sure all of you in the audience, as taxpayers, would have seen the several and different elections which were available in the corporate tax return this year. And these elections will also be available, of course, on 30th September 2026. So, my friends, let's first talk about certain reliefs. Now, let's say you are an entity, let's say you're in mainland. All right. Now, if you're in mainland and if your revenue or if your turnover doesn't exceed 3 million dirhams, yes, my friends, if your revenue or your turnover doesn't exceed 3 million dirhams, then you're eligible to claim something called as the small business relief. All right. If you claim the small business relief, then what happens is that for this year, for 2025, you do not have to pay any tax. And this benefit you shall get until 31st December 2026. Yes, my friends, this relief is available with a sunset clause, which means if your revenue threshold doesn't exceed 3 million dirhams, then you're eligible to claim small business relief, which means that you do not have to pay any tax. So that is one of the reliefs which is available. All right. Now, when we talk about the other elections which are there, like we talked about the free zone elections, right? So you have to see if you're a free zone company, if you want to claim the qualifying free zone person benefit, then you can elect to get the free zone election, wherein you have to ensure that you meet all the six conditions laid down by Article 18. But to emphasize one more point here, my friends, if let's say you want to form a tax group, then what happens? I'm sure many of you in the audience would be already contemplating that, okay, we want to form a tax group. Why? Because we have multiple entities across UAE. Now, let me give you an insight there as we're talking about the elections and as we're talking about the reliefs on this slide. So, my friends, I'll give you an example. Let's say you have multiple entities in UAE. All right. Some of them are mainland, some of them are free zone, right? But let's say all of them are under the ambit of one ultimate beneficial owner, which means under one UBO. Let's say we have an individual at the top who is having 100% ownership in all these entities in UAE, the mainland entities also and the free zone entities also. What happens then? Can we form a tax group? Now, the answer is no. Yes, my friends, as per Article 40 of the law has categorically talked about the fact that to form a tax group, we need to have a parent entity at the top. So, in the situation which we just talked about, what we have to do? What is the solution so that many taxpayers in the audience there can form a tax group? So, my friends, the solution is that you have to do a restructuring of the shareholding, right? You have to do a restructuring under the ambit of corporate tax law to ensure that you're meeting the conditions of Article 40 and you make one entity as the parent entity at the top. Now, this parent entity shall have minimum 95% shareholding in all the entities below, right? But then what happens to my free zone entities? If I have a free zone entity in this group, can it still be a part of the tax group? Number one. Number two, the question in your mind shall be that can it still claim the qualifying free zone person benefits? So, my friends, let me answer that question very simply for you. Let's say in this group of companies which you have mainland, all right, fine. The parent entity has minimum 95% shareholding in the mainland. This mainland entity can form part of the group, all right. But what happens to my free zone companies? So, my friends, for the free zone companies, if you want to form a part of the tax group, if you want to become a participant or a member of the tax group, then for a free zone company, you have to let go and you have to forego your benefit or your eligibility to becoming a qualifying free zone person. So, my friends, the law is very careful and it's very strict with respect to the benefits which it is giving to the taxpayers. So, the law says that either you become a free zone person, a qualifying free zone person, you get 0%, or you become a member of the tax group. You cannot have the best of both worlds, which means if you are a qualifying free zone person, then in that case, you have to let go of your benefit of 0%. Only then can you form part of the tax group. So, my friends, if you want to form a tax group, please be very careful that you check all these conditions very, very carefully as per Article 40. And let me tell you one more thing. For all these conditions as per Article 40, these conditions have to be met throughout the year. Only then will you be eligible to forming a tax group. Let me tell you practically now. Let's say we are in 2025 today. Now, in 2025, if you do all this restructuring, all right, and you apply for becoming a tax group, then the advantage which you'll get for forming the tax group that shall start from 1st January 2026. Why? Because as per Article 40, they have categorically and clearly mentioned that you have to meet the conditions throughout the year. We can move to the next slide, please. All right, my friends. Now, in the next section, we'll be talking about what are the areas from which we should focus on transfer pricing compliance for 30th September 2026 to be prepared that what all aspects we should focus on during 2025 from the transfer pricing perspective. Let's move to the next slide. All right, my friends, that brings us to the second poll question of the day. And the question is, are all entities required to maintain local file and master file? You have 30 seconds to answer. Your time starts now. All right, my friends, thank you so much for the response. And more than 70% of the people have answered the question correctly, saying that no, all entities are not required to maintain local file and master file. We'll talk about this in greater detail as we move to the next slide. All right, my friends. Now, let's talk about transfer pricing compliance. Let's talk about the transfer pricing documents. What is applicable, what is mandatory for everybody, and what is optional for everybody as a taxpayer. So, my friends, as you can see on this slide, we've given four kind of transfer pricing documents. We've talked about master file, local file, transfer pricing disclosure form, and country by country reporting. Now, let's lay some emphasis here and talk about the transfer pricing compliance. So, my friends, now as we know, right? In the corporate tax return, all of us have seen the fact that in the corporate tax return, there is a particular column and there is a particular schedule wherein two questions are asked. One is about related parties, the second is about connected persons. Now, what are these questions? Now, as we've seen, the FTA has clearly asked in the corporate tax return that do you have any related party transactions? If you select yes, the next question is that is the quantum or is the volume of the related party transactions, is the value of the related party transactions exceeding 40 million dirhams? All right. If the answer to that is also yes, then we have to fill a particular schedule. Now, what is this schedule? So, my friends, this schedule is nothing but this schedule is the transfer pricing disclosure form. In this schedule, my friends, the FTA asks about who are our related parties, what is the related party transaction which we're having with them, what is the book value of such transaction, what is the market value of such transaction, and what is the most appropriate method which you as a taxpayer are using to benchmark this particular transaction. Yes, my friend, all these aspects you have to talk about and disclose to the FTA if the volume or the value of your related party transactions is exceeding 40 million dirhams. So, my friends, now in that, all right, book value we know from our balance sheet, but what about the market value? What about the most appropriate method? So, my friends, now since 2025 is a new start, it's a new beginning, let's be very careful with respect to transfer pricing compliance. Now, to find out the market value, to find out the most appropriate method, what do we as taxpayers have to do? What we have to do, my friends, is that we have to do a transfer pricing benchmarking analysis to find out that which is the most appropriate method which we are selecting as a taxpayer and what is the market value of the related party transaction. Now, I'll just give a brief to you here. What are the most appropriate methods? We have CUP, we have TNMM, we have RPM, we have CPM, we have PSM, we have other method. All right. All these are the methods which are available as per the FTA transfer pricing guide, along with the OECD. Why? Because the FTA has said that whatever we are laying down in transfer pricing, all our regulations are inspired and all the regulations are completely in line with what the OECD guidelines have said. All right. So we have to be very careful that which out of these methods are we selecting as the most appropriate method. And depending on that, my friends, we have to use a publicly acceptable and a publicly available database. That is what the FTA has mentioned in the transfer pricing guide, which they published long back now in October 2023. They have not given the name of any particular database, but as all of us know, there are multiple databases out there in the market, and we can use any of those databases to find out what is the arm's length price of my related party transactions. That is something, my friends, which is mandatory to be disclosed in the disclosure form. Point number one. Point number two, the second question which the FTA has asked in the corporate tax return is that are you making payments to your connected persons? Which means, are you making payments to your key managerial personnel? For most of you, the answer is yes. Yes, of course. Why? Because we do make payments to our MDs, we make payments to our directors, we make payments to our CEOs, CFOs, all the C-suite employees. Yes. And we also make payments to our shareholders and partners, right? Now, since those individuals are the heads and brains of the company, and since those individuals are exercising significant control over the company, right, they are categorized as connected persons, and whatever payments you're making to them, the FTA asks the next question is that is the value of these payments exceeding 500,000, right? Now, if the answer is yes, then again there is a connected person schedule which you have to fill. This connected person schedule is also categorized as the disclosure form details. Now, in this connected person schedule, my friend, you have to fill. You have to talk about the name of the individual, what is their designation, what is the salary, what is the benefit, what is the bonus which you're making to them, and what is the market value of those transactions. So again, you have to find the market value of how are these individuals being paid in the market, right? All these details, my friends, are mandatory and you have to furnish in the disclosure form. Now, this aspect is something which is mandatory. Now, what is not mandatory for transfer pricing compliance and which is optional, right, is the three-tier documentation. Yes, my friends. Now, the three-tier documentation comprises of your local file, master file, country by country reporting, and it is only applicable in your case if you're crossing the statutory thresholds. Now, what are these statutory thresholds? So, my friends, these statutory thresholds are For local entity, if the revenue crosses 200 million dirhams, or if you're a part of an M&E group and the threshold or the revenue, consolidated revenue of the M&E group, if it crosses 3.15 billion dirhams, in that case, my friends, you have to prepare local file at the entity level and master file at the group level. Yes, my friends, as we know, local file is nothing but a blueprint of the transfer pricing documentation for an entity, wherein we talk about the entity, what is the group, if it is a part of a group, what is the industry analysis, what is the FAR, wherein we conduct a detailed FAR analysis to find out what are the functions, assets, risk, what is the correct characterization of the entity, and ultimately in the economic analysis section in the local file we perform the detailed benchmarking analysis. That is what comprises of the local file. Now master file, my friends, is nothing but a blueprint of a group of a whole. It talks about the value drivers in the group, it talks about what are the strategies of the group, which entity holds intangibles, which entity is assuming what risk, how is the risk reward matrix placed across the group. And last but not the least, my friends, country by country reporting, wherein we talk about the revenue, profits, taxes, which are payable by each and every entity in each and every jurisdiction throughout the group. So, my friends, this is what the compliance comprises of. Mandatory is the transfer pricing disclosure form in the corporate tax return, and optional is the three-tier documentation as per BEPS Action Plan 13, which is local file, master file, country by country reporting. We can move to the next slide, please. All right, my friends. Now, as we were talking about the disclosure form, what are the aspects which we should keep in mind when we are filling the disclosure form in the corporate tax return? So, my friends, like I said, in the disclosure form, we have to be very careful that we talk about what are the related party transactions, what are the connected person transactions, what is the value of these transactions as per the books, right? What is the most appropriate method which we are using? What is the fair market value or the arm's length price? All right. All these aspects we have to be careful about and we have to disclose in the disclosure form. Now, what is important when we disclose all these is that we have to be very careful that we select the correct, most appropriate method. Now, if we talk about the most appropriate method, my friends, as per the OECD, we have 5+1 most appropriate methods. And the FTA has also said that the FTA shall align the transfer pricing regulations with the OECD guidelines. Yes. Now, when we talk about these methods, what are these methods? Okay, I'll take you through all of them in brief. Now, my friends, the first method is CUP, which does an apple to apple comparison. Why? Because it is a comparable, uncontrolled price method. Now, the second method is RPM, which is mostly used in case we are testing the gross profit margins for distributors, right? Then we have cost plus method, which is used in case of manufacturers and service providers. But let me give you a practical insight there. When we talk about RPM or CPM, they are not widely used. Why? Because there are multiple situations wherein for RPM specifically, the gross profit margins are not the true representatives of the company's profitability. Yes, my friends. Now, when we talk about gross profit margins and net profit margins, what is the difference? Now, the gross profit margins do not take into account the indirect cost element which is shown in our profit and loss account. Now, because of that, what happens is that only the direct cost element is taken care of, and because of that, only the gross profit margins are tested. Now, these gross profit margins do not take into account the net figure, number one. Number two, they do not take into account the effect of the indirect cost or the indirect expenses. Hence, it is mostly preferred that gross profit margins are not used. And when we talk about cost plus margins, similarly, even cost plus margins talks about the direct cost and not the indirect cost, again, which is not the true representative of the business or the operations of the company. Hence, even for distributors and manufacturers, practically, my friends, the method which we use mostly and the widely used method across the globe is transactional net margin method, which is TNMM. Now, in TNMM, my friends, we test the net margins, all right? We take a profit level indicator, which will be operating profit by operating cost or operating profit by operating revenue, depending on which side of my transaction is controlled or which side of my transaction is tainted. All right, that is about RPM, CPM, TNMM. Now, let's talk about PSM, which is profit split method. So, my friends, profit split method is used wherein we have, let's say, two entities within a group, and these two entities, let's say, both of them are not the least complex entities. Yes. What do we mean by least complex, my friends? We mean that both of these entities have certain degree of intangibles which they are holding. And because of the intangibles, we say that they are not the least complex entities, number one. Number two, if their operations are closely linked or intertwined with each other. Yes, if their operations are closely linked or intertwined, even in that case, we use profit split method. And in the profit split method, my friends, there are two approaches of doing a risk reward analysis or doing the delineation of the profits, as we say technically as per OECD. We either follow the residuary approach or we follow the contributory approach, depending on which entity contributes to what percentage of the value creation of the entire transaction chain. Depending on that, the profits shall be attributed to that entity. Now, last but not the least, if we talk about other methods, so my friends, other method is used in those cases wherein, let's say, we used any third party valuers report, we use any independent valuers report, we use any actuarial report, or any DCF approach. All right, all these things, if you're using any third party reports or any third party quotations, in those situations we say that we are using other method to benchmark the particular transaction. So these were the critical aspects, my friends, which you must keep in mind when you're filling the transfer pricing disclosure form. We can move to the next slide, please. All right, now let's just talk a brief about that. What are the compliance obligations which we must keep in mind when we talk about transfer pricing? So, my friends, for transfer pricing, we should be very careful that we are having a strong internal check in place. All right. In your entity as a taxpayer, please be careful that you're regularly doing these internal audits, wherein you have a clearer look at your financial statements, you have a look at whatever aspects can possibly be picked by the FTA during the audit. You have a look at whatever inconsistencies you have in your trial balance, your profit and loss account, or in your statement of position, which is your balance sheet. All right. All those aspects, you must ensure that you take care of them when? During FY ending 2025, before 31st December 2025, my friends. Why? Because if these aspects are not taken care while you're making your financial statements, before you get your financial statements audited, then it will have a direct adverse impact on your corporate tax return when you file it during 30th September 2026. So please be very careful that you do a proper internal strong check of all your documentation which you have. Number one. Number two, my friends, for whatever transactions you're having, whether with your related parties or whether you're making payments to your connected persons or even with third parties, to be honest, right? Please be careful that you have all the agreements in place. You have all the intercompany agreements, you have all the invoices, you have all the debit notes, all the credit notes, all of it in place. Why? Because once you file your return, after that, the FTA can reach out and they can request for the supporting documents. So please be very careful that you monitor all your transactions, all your documents very carefully. And last but not the least, please try that you do the correct characterization of your entity. Yes, please try that you do the correct FAR analysis, which is the functions, assets, and risk analysis, to see that what are the functions which you as an entity are undertaking in this entire value chain or supply chain. Let's say if you're a distributor, please try and understand whether you're a full-fledged distributor, limited risk distributor, or a commissioner agent, right? Or if you're a manufacturer, please try and see whether you're a full-fledged manufacturer, licensed manufacturer, contract manufacturer, or toll manufacturer. Similarly, if you're a service provider, you have to understand whether you're a high value service provider or a low value service provider. Now, depending on all these things, you have to characterize yourself as the correct entity type, with which means as per the correct characterization. Why? Because depending on your characterization, we have to justify to the FTA that what are the margins of profits which are being allocated to you, depending on what kind of entity you are, whether you're a full-fledged distributor, whether you're a licensed manufacturer, whether you're a high-value service provider, or a low-end manufacturer, distributor, or service provider, depending on what is the case. So please be very careful that you have all these internal reviews and all these internal checks regularly being done in your company during 2025. We can move to the next slide, please. All right, my friends. Now, in this section, we'll talk about the fact that what should we expect during the FTA audits from the corporate tax and the transfer pricing point of view. We'll discuss this in detail. Let's move to the next slide. All right, now that's the third poll question of the day, my friends. And the question is, which of the following best describes a common mistake the FTA may flag during the audits? You have 30 seconds to answer. Your time starts now. All right, very interesting, my friends. More than 90% of the people have answered the question correctly, saying that yes, all of the above are the mistakes which the FTA may flag during FTA audits. We'll talk about this in detail. Let's move to the next slide. All right, my friends. Now in this section, what we'll talk about is the fact that what are the issues which the FTA may flag during the audits? What are these issues for corporate tax? What are these issues for transfer pricing? So, my friends, if we talk about the issues, now the first issue which the FTA can pick up is the inaccurate bookkeeping. Yes, my friends, depending on how your accounts are classified, how you've classified your general ledger heads, and how is the bookkeeping or the financial records that you're maintaining at your end being managed. Depending on that, these aspects can be questioned by the FTA. So please be careful that you're having a proper bookkeeping system in your entity. You're having either QuickBooks or Zoho. There are multiple accounting softwares available out there. So please try that you use a proper accounting software to ensure that all your entries are done accurately during 2025 so that the ultimate picture which comes out to you during 2026 before you file your corporate tax return is an accurate picture. Number one. Number two, my friends, you have to be careful that the thresholds which we talked about for the transfer pricing disclosure, you have to be careful that you actually check what are the thresholds of your related party transactions, what are the connected person payments you're making, and you try that you correctly report these transactions in your corporate tax return. Number one. Number two, my friends, in your corporate tax return, there is also a column of voluntary adjustment. Yes, either upward adjustments or downward adjustments. For downward adjustments, we need a prior approval from the FTA, which the FTA has mentioned. But for upward adjustments, wherever you yourself want to do a voluntary adjustment, it's always better that you offer more amount to tax to be careful and to out of abundant caution to avoid any penalties or any cherry picking by the FTA later during the FTA audits. So please try that you see that whatever related party transactions you're having or whatever connected person transactions you're having, if your book value of such transaction is exceeding the 75th percentile defined by the FTA. Yes, my friends, the FTA has said that we need to be sure that our related party transactions or connected person transactions fall within the interquartile range. What is this interquartile range? It is the 25th percentile and the 75th percentile. So, my friends, in cases wherein our related party transaction exceeds the 75th percentile or our connected person transaction exceeds the 75th percentile, we have to do an adjustment. So, please be careful that you do these adjustments in your corporate tax returns because these are the issues which shall be picked by the FTA. All right. And last but not the least, you have to be sure that there is no excess profit being shifted from UAE to a low tax or to a no tax jurisdiction. Yes, all these aspects, my friends, you have to be very, very careful about. And yes, now since we are in 2025 and since we know that the corporate tax deadline for 2025 shall be 30th September 2026, so please be very careful that you do not miss this deadline. Yes, of course, you have almost 1 year left right now to complete all your corporate tax and transfer pricing compliances. So please be very careful that all these categorizations, all the compliances, all the documentations, all the bookkeeping, and all the internal checks are followed by your company throughout 2025 so that you do not miss the deadline on 30th September 2026. We can move to the next slide, please. All right, my friends. Now, if we talk about any possible audit risks which can arise for transfer pricing during the FTA audits, let's spend a moment here and talk about those audit risks. So, my friends, what are the audit risks and what are the chances and what are the cases which may be picked by the FTA? Now, the first thing is that there may be a situation wherein the taxpayer is unable to categorize or characterize their related party transactions. Yes, my friends, any failure of reporting any significant related party transactions is an aspect which can be questioned by the FTA. So you have to be very careful that you report your related party transactions appropriately. Number one. Number two, you have to see that if you're making any margins, then are you able to justify those margins with your FAR? Let's say you are a full-fledged distributor, or let's say you're a licensed manufacturer, then definitely whatever profit margin you shall be earning shall be high end and it shall not be lean. Why? Because lean margins are related to either limited risk distributor or with contract manufacturer, toll manufacturer, or low value added service provider. So, depending on what is the characterization, your margins should actually be aligned with your characterizations. Number one. Number two, when we talk about any non disclosure requirements. So, my friends, like I said, please be very careful that you do a proper disclosure of your related party transactions, connected person transactions, whatever other amounts as per book value, and whatever other amounts as per the benchmarking activity which you've conducted. All that should be aligned and all that should be properly presented in your corporate tax return. Why? Because these are some issues which can trigger questions by the FTA during the FTA audits. We can move to the next slide, please. All right, my friends. Now, in this section, let's talk about the correct characterizations or the classifications of the related party transactions, like I said. Now, depending on what is the related party transaction you are having, like I said, each industry is categorized into three different subsectors. We have manufacturers, we have distributors, we have service providers. So, my friends, if you're a manufacturer and if you hold any intangible or any intellectual property, you shall be characterized as a licensed manufacturer, and whatever profit attribution shall be done to you shall be a higher profit attribution. Why? Because as a licensed manufacturer, you're involved in end to end transactions of the supply chain. Number one. Now, when we talk about the classification, like I said, when we talk about the manufacturers, we have to see that what is the profit which shall be delineated to us. Now, as a full-fledged manufacturer, if we have intangibles or if we have an intellectual property, then automatically whatever reward shall be attributed to us shall be higher than that of a contract manufacturer or a toll manufacturer. Number one. Number two, if we are a contract manufacturer or a toll manufacturer, we have to see which of these two manufacturers are we. How? Because we have to see whether we are providing raw materials as well as the instructions, or whether we are just providing the raw materials, right? Depending on that, we have to see that whether we are characterized as a contract manufacturer or a toll manufacturer. Similarly, when we talk about the distributors, we have to see that as a distributor, are we involved in the full distribution supply chain? If the answer to that is yes, then we say that we are a full-fledged distributor, and automatically whatever margins are being allocated to us, those margins shall be higher. All right. Now, if we talk about any limited risk distributor, if we talk about any limited risk distributor, then we have to see that what part of the value chain are we a part of? As a limited risk distributor, are we undertaking all the activities of the distribution value chain? Are we undertaking all the activities of the distribution supply chain? Are we undertaking all the activities of the distribution supply chain? Depending on that, we have to see that if we are a limited risk distributor, what are the margins which shall be delineated to us? What are the profits which we shall earn as a limited risk distributor? Because, my friends, the primary difference between a full fledged distributor and a limited risk distributor is that the limited risk distributor is not undertaking all the activities of the distribution supply chain. That is the primary difference, and because of that, limited profits or limited reward is allocated to an LRD. Now, last but not the least, if we talk about commissioner arrangements, in the commissioner arrangements, the distribution agent or the entity which is working on the commissioner model gets a commission on the basis of the goods which are being retailed, sold, or distributed. Now, depending on all these aspects, my friends, you have to see that what is the profit margin which you're earning. Again, I reiterate, the profit margin has to be aligned with the kind of activity which you're undertaking. Yes, all these classifications you have to be careful of, and you have to carefully evaluate before you file your corporate tax return during 2026, September 30th, right? And last but not the least, if we talk about service providers, my friends, so for service providers also, as per law, there are two different categories. If you're doing any low value added services, then in that case, you shall be remunerated with a cost plus 5% safe harbor margin, which has been defined by the transfer pricing guide published by the FT in October 2023. Or if you're doing any high value added services, then of course the profit margin and the profit at which your entity shall be working shall differ. We can move to the next slide, please. Okay, that brings us to the fourth poll question of the day, my friends. And the question is an individual in the key strategic decision making for an entity considered as a connected person as per law? You have 30 seconds to answer. Your time starts now. All right, thank you so much, everybody, for answering that question correctly. And almost 95% of the people have answered the question correctly, saying that yes, individual involved in the strategic decision making is considered as a connected person. Let's talk about this in greater detail as we move to the next slide. All right, my friends. Now, let's talk about connected persons in a bit. Now, who are these connected persons and why are they referred to as connected persons? Now, my friends, as per law, as per Article 36 of the Corporate Tax Law, they have clearly mentioned that any individuals who are at the key strategic decision making positions in a company, wherein the law has mentioned that individuals who are exercising significant control and significant influence over the business of a company are considered as the connected persons. Now, whatever remunerations are being paid to these connected persons, these remunerations have to be at arm's length price, which means they should be at fair market value, at par with how other individuals like them, similar individuals like them, are being remunerated in the industry or in the market in general. So, my friends, please be careful that number one, you have your departmental chart practically ready with you, wherein you can clearly see that who are the individuals who are part of this departmental structure, what are their roles, what are their responsibilities, what is their designation, are they actually involved in exercising significant control and influence over the business? If yes, then they shall be considered as connected persons for the company. All right. And whatever remunerations you're paying to these connected persons, those remunerations, and by remunerations, we mean the comprehensive package, the fixed salary, the variable salary, the bonus aspect, the perk visits, all of that together should be at arm's length price. It should be at fair market value. So, my friends, please be very careful. Number one, you have your departmental chart ready. Number two, you correctly identify and you characterize the designations, the roles and responsibilities of these individuals. And last but not the least, you do a proper disclosure in the corporate tax return, in the disclosure form for whatever remunerations you're paying to these individuals, because this is mandatory as per law. And you have to see that are these payments exceeding 500,000? If yes, you have to fill the return with the disclosure form in the return. If not, and if you feel that you've done the benchmarking, if there are any adjustments required, if let's say in your case the remuneration doesn't exceed 500,000, but if it is still above the 75th percentile when you do the benchmarking, then it is always advisable that you do a voluntary adjustment yourself, which means you add back the excess disallowance to the net profit and you pay tax on a higher sum out of abundant caution to avoid any risk of penalties by the FTA in the future. We can move to the next slide, please. All right, my friends. Now, In the last section today, we'll talk about what is the way forward for financial year ending 2025. As we know, we are 2 months away from this year to end. So, what are the steps, what are the measures which we should take care of to ensure that our books for Jan to December 2025 are proper, are aligned, so that there are no issues which we face during 30th September 2026 at the time of our return filing? We can move to the next slide, please. Okay, now my friends, let's talk about the fact that how should we prepare ourselves for 30th September 2026 now? Okay, so in this slide, what we've done is we've actually summarized all the discussion points which we discussed in our webinar today. We talked about the fact that we must have our general ledgers in place. We must have our correct bookkeeping practices in place. We must ensure that we do the correct classification of the expenses, the allowances, the disallowances. Number one. Number two, from the transfer pricing aspect, we must be careful and we identify our related parties, whatever related party transactions we are having with them, who are our connected persons, what are the remunerations we are paying to them, are these remunerations at fair market value? All these aspects, my friends, we must carefully check during 2025 to ensure that we do the correct disclosure on 30th September 2026. And last but not the least, what is the basis of your financial statements, my friends? The basis is correct bookkeeping and having a proper trial balance. So please be careful that you reconcile your trial balance with your accounting software, whatever data you've put in the accounting software, and all your numbers, all your categorizations, all your classifications, and all your narrations should be in line. Why? Because these will have a direct impact on the schedules or on the notes which you ultimately put in your financial statements next year. We can move to the next slide, please. Okay. And my friends, there is one more suggestion which can be a value add for all the audience out there is that now during 2025, it is advisable that you do a proper health check. And why we say health check? By health check, we mean you analyze all the aspects of your trial balance, of your financial statements, of your related party transactions, of your connected person transactions, so that why you can identify any errors, any inaccuracies beforehand. You can see that you ensure that you're doing the proper reporting in the corporate tax return next year. And if you do a health check, you'll also be able to analyze that what is the perspective risk, right? What is the prospective risk? What are the areas which the FTA may challenge? So, my friends, 2025 is extremely critical. Why? Because this is the post compliance year, and in this year, the FTA shall have a precedence with respect to whatever decisions they take for all our corporate tax returns which belonged to 31st December 2024. So whatever stand the FDA has to take for 2024, they shall take now after we file the corporate tax returns on 30th September 2025, and that shall set the precedence for the FDA and for all of us as taxpayers for 30th September 2026. So please be very careful that you ensure that you do all the compliance as per UAE corporate tax law. Please be careful that you do all the appropriate reportings from the transfer pricing as well as the corporate tax perspective. We can move to the next slide, please. All right, now, my friends, that brings us to the fifth poll question of the day. And the question is, how long must corporate tax records be maintained under the UAE corporate tax law? You have 30 seconds to answer. Your time starts now. All right. Thank you so much, everybody, for answering that question correctly. And the question is 7 years. The corporate tax records must be maintained under the UAE corporate tax law for 7 years. Why? Because that is a requirement which the FTA has mentioned under Article 55, under Article 56 of the law. Let's talk about that in greater detail as we move to the next slide. All right, my friends. Now, the last aspect which we'll be discussing today is the record keeping and why is it important. Now, as all of us know, whatever points we discussed in the session today and whatever points we've been discussing in all our webinars before as well, All of it revolves around appropriate, effective, seamless, corroborative documentation. Yes, my friends, when we talk about documentation, we have to see that whether our records are being maintained digitally or whether our records are being maintained physically. Depending on our record keeping, we have to be careful that we have the correct characterization, the correct labeling of all our general ledgers, of all our books of accounts. We must ensure that we have all our debit notes, credit notes, policies, agreements, all of it in place. And my friends, it is up to you to see that what are the ways wherein you're maintaining your documents. Are you having your documents in physical form or are you having your documents in online form? It is always better to have like an online archival facility. You can have a Dropbox, you can have a OneDrive. Why? Because there is a seamless retrieval of records and the physical loss or damage of data or records is also prohibited if we have online documents maintained. Now, my friends, with that, we come to the Q&A session, and I'd like to hand over to Nirmeen to start the Q&A session. Thank you so much.
Thank you, Ms. Aditi, for providing such an insightful and engaging session. We'll now move to the live Q&A segment. Before we proceed, we'd like to let you know that the webinar feedback section is now live. We'd greatly appreciate if our audience could take a moment and to share their valuable feedback. Additionally, we also request you to leave a review on Google by simply scanning on the QR code displayed on your screen. Your feedback is important to us. Now we invite Mr. Millen to address the question for our audience.
Good morning, everyone. So let's move on to the Q&A section. We have a few questions for this day. The first question is from Mr. Ahmed. Now that the first corporate tax return is done, what should companies really focus on next?
Thank you, Mr. Ahmed, for that question, and thank you, Milan, for putting that across. Now, since the first corporate tax return season is done, Mr. Ahmed, so now what should you focus on next? Now, what you should focus on next is what is happening in your books of accounts during 2025. Now, during 2025, Mr. Ahmed, you have to be very careful, like we said. You have to see that how are you classifying all your general ledgers? How are you maintaining all the documents which you have? Are you trying to have the correct reporting standards in the books? Are your books as per IFRS? Are you doing the audit of your books? Is audit mandatory for you? Is it not mandatory? What is your revenue threshold, whether you're a mainland company, whether you're a free zone company? Depending on all these aspects, you have to see that number one, you characterize your books correctly. Number two, you have a proper accounting system. Number three, you must report and you must identify your related party transactions as well as your connected person transactions. All these aspects, Mr. Ahmed, you must be very careful of and you must check. Now, Milan, what do you have to say from a practical perspective about that?
Yeah, additionally, would like to add that for the current filings season also, we could see if there are any adjustments required, so we can make a voluntary disclosure or an amendment to the current application, just to make sure everything is aligned, the supporting schedules are on par. Because that can make a huge difference going forward to the audit season. Yeah. Next question we have from Huda. Do we have to refresh our transfer pricing benchmarking every year?
All right. Thank you so much, Huda, for that question. And that's a very commonly asked question, which even Milan will agree. Now, Huda, what we have to do is that the transfer pricing benchmarking has to be done every 3 years. Now, as we know for 24, the data which you took for to present the weighted average numbers was 22, 23, 24. Now, for 25, you'll take 23, 24, and 25. Similarly, for 26, you'll take 24, 25, and 26. Now, after 26, yes, you'll have to do a fresh search, number one. Number two, Huda, you also have to take into perspective and take into account the fact that if during these 3 years there is any new transaction which your company is undertaking, number one. Number two, if there is any new wing or any new division which your company has started and for which you're having your transactions with group affiliates, then in those situations, yes, for that new transaction, for that new segment, you will have to do a new benchmarking during these 3 years. Otherwise, if your business remains status quo, which means if your business remains as is as it was during 2024 for the coming forward 3 years as well, then yes, you just have to perform a financial update in your benchmarking on an year-on-year basis for 3 years, but no fresh benchmarking has to be done. What do you have to add to that, Milan?
Rightly said, Aditi, because the market changes, margin moves, and also the comparables may no longer reflect the actual reality. So, having an updated benchmarking report will be better and a lot smoother because that'll be like they'll be backed by the current data, so it'll be better for the future of FTA audits as well. Next question we have from Imran. What should smaller business or those under small business really focus on?
All right, Imran, thank you for that question. Now, if we talk about SBR, so if your revenue threshold is not exceeding 3 million dirhams, then Imran, you have to see that are you following the IFRS for SMEs? Now, in the ministerial decision number 73, which the law has published for small business relief companies, they have categorically talked about the fact that if you are a small business relief company, which means if your revenue threshold doesn't exceed 3 million dirhams, then in that case you have to follow IFRS for SMEs. Yes. In the IFRS which are there as per the global accounting standards, there are certain IFRS which are applicable for SMEs. You have to be careful that you follow those IFRS, number one. Number two, if you're an SPR company, then you are eligible to maintain your books either on cash basis or an accrual basis. So that aspect also you should check. Number three, for an SBR company, in case you're having any related party transactions and connected person transactions, then number one, as per law, you are not required to disclose them in the corporate tax return. Why? Because as you must have seen, Mr. Imran, is that in the return which you would have filed on 30th September 2025, also as soon as you select that you're eligible to claim the small business relief, the follow on schedules for related party details, connected person details, all those do not come, right? So, reporting your related party transactions or connected person transactions is not applicable. But please be very careful because the law has categorically mentioned that the FTA has the liberty and the FTA is eligible and they are permitted to still come back to you and ask you for details for whatever transactions you're having with any of your group affiliates, if you have any group affiliates, and whatever payments you're making to your connected persons who are your key managerial personnel. So you have to be careful that even though you're claiming the SBR benefit, still if you have transactions with your group affiliates or still if you are making any payments to your connected persons, all that should still be at arm's length, it should still be at market value, and you must maintain all these documents at your end. What do you have to say about that, Miller?
Yes, even if you're under the threshold, you still need to maintain proper books, invoices, and prove that the revenue is within the limit. And yeah, if the business grows and crosses the threshold in future years, this documentation again becomes a baseline for accurate tax calculations. And yeah, thank you for all your wonderful questions. Due to time constraint, I just hand it back over to Nirmi to conclude this webinar.
Thank you, Mr. Milan and Ms. Aditi, for delivering such an informative and engaging session. A big thank you to everyone in the audience for joining us today and contributing to this experience. Your presence and active participation have truly made this session valuable and impactful. We look forward to connecting with you again in our future webinar. Until then, if you have any further queries regarding excise, VAT, corporate tax, please feel free to drop us an email or give us a call. The contact details are on the screen. Thank you once again.